REITs appear to be in demand once again. With the macroeconomic uncertainty that 2022 brought upon the global markets, investors apparently stayed clear of this investment class, with a pessimistic outlook towards rental income and occupancy trends. However, this fearful hesitation has evidently proven to be far-fetched. REITs have been driven down in the bearish market panic, despite rock-solid fundamentals. This therefore presents a golden opportunity for investors to consider parking their funds in REITs. In the current environment, there are several compelling reasons why REITs are the greatest option for any investor looking to initiate a fresh position for 2023. Firstly, their values are at the most appealing they have been in years, thanks to extraordinarily cheap pricing coupled with rock-solid fundamentals. Furthermore, rental income trends are at historic highs, translating into exceptionally attractive dividend yields. As a result, private equity groups have been amassing REIT equities at an unprecedented rate. Investors should not pass up this wonderful chance. In light of this, we bring forth a list of 5 best REIT stocks that are screaming buys in January 2023. The first stock on our list is that of Healthcare Realty Trust Inc., which trades by the ticker HR. Healthcare Realty is a great pick for conservative income investors that are seeking to sail through the challenges of 2023 in a well-prepared manner. The company has a strong balance sheet, a defensive portfolio of medical office real estate, an excellent track record, and healthy high-digit growth of funds available for distribution. Owing to stable demand for medical office units, HR is set to close in 2022 with revenue amounting to $930 million, up significantly from $534 million in 2021. Similarly, the management is committed to spending over $500 million in the coming quarters on share buybacks, promising greater value appreciation to shareholders. Despite such a strong year, its share price remains more than 30% below its price from a year ago. Its current share price of $19 reflects a 35% discount to net asset value, and is significantly below the $31 price that was offered for an acquisition last year by Welltower. This clear undervaluation makes HR not only a very strong REIT business offering stable and inflation-proof income, but also one that offers its shareholders tremendous value. Additionally, its 7.41% dividend yield adds to the attraction the investment offers, making it a highly compelling buy. The second stock on our list is that of the Canadian player, Kite Real Estate Investment Trust, which trades in the Toronto Stock Exchange as CRT. The REIT was formed after completing its spin-off with the Canadian Tire Corporation in 2013, and occupying 92% of CT's gross leasable area, remains its largest tenant by far. Normally, this lack of tenant diversity would be considered problematic, but the Canadian Tire Corporation has a market cap exceeding $9 billion, has been in operation for over a century, and stands as one of the most popular Canadian retail brands. Moreover, its strong investment-grade credit rating makes it a sound business that adds stability to CT REIT's cash flows. In total, CT reports over 370 properties across Canada, with a total leasable area of 30 million square feet, all while reporting an impressive occupancy rate of 99%. Its payout ratio is relatively low at 75%, but allows for up to $70 million to be retained to finance further development. Due to this growth-oriented business strategy, the company boasts a compound annual dividend growth rate of over 25% in the last 3 years alone. Despite this low payout and high growth combination, CT still delivers a respectable dividend yield of 5.5%. In addition to these rock-solid business fundamentals, the financing of the company stands as being highly appealing to investors. Its 41% debt-to-gross book value ratio suggests highly conservative financing for a REIT of its size. Moreover, 96% of its total debt has a weighted term average of 7 years, and is based on fixed interest rates. This makes CT immune to the volatile and aggressive interest rate environment impacting large businesses. For those seeking stable income growth, while ensuring minimal risk exposure, CRT is a great investment and a very strong buy. Before we move on to the next stock, we'd like you to know that we offer a morning newsletter to our email subscribers. Prior to the market opening, we send our subscribers an informative email about which stocks are moving or about to move. You will get an overview of key earnings reports, recent insider transactions, analyst upgrades, and downgrades. To take advantage of this offer, you can find the link in the description box. If you're still with us, it means you've liked our video. Do click on the like button to show your support. Number 3 on this list is one of America's top 5 shopping center REITs, Kite Realty Group Trust, which trades by the ticker KRG. This Indianapolis-based real estate player has been a formidable name in the REIT space for the last 60 years. More than 2/3 of its properties lie in the high-growth and commercially viable Sun Belt zones, whereas the remainder is found in lucrative strategic gateway markets, typically found in metropolitan regions. The management has been committing to a sustainable business strategy of thriving in an e-commerce environment, with 3/4 of its annual base rent coming from sites containing a grocery unit. Given these strengths, performance has been quite strong, with Kite enjoying significant favorability from its existing tenants. In the third quarter of 2022, net operating income rose year-over-year by 4.4%, whereas annual base rent saw a jump of 7.7% overall. Given the nature of its real estate, Kite Realty enjoys a significant advantage as a REIT, being strong cash leasing spreads. Over 22 of its recent lease signings reported a spread of 31%, whereas its portfolio leased rate grew to 94% over the year. Moreover, the REIT enjoys a solid balance sheet and BBB ratings from both Fitch and S&P. In fact, its financial position is so robust, even in this macroeconomic environment, it acquired from the bond market a $300 million loan for 3.95% over a 7-year period. Its total cash position therefore exceeds $1.2 billion, which is more than sufficient in funding its expansionary development programs. The management is focused on an expansion into the family unit market, which boasts high profitability. With both the resources and strategy to successfully execute, KGC stands as being a brilliant investment opportunity. As a testament to its strength, Bank of America recently upgraded its position on this REIT star from neutral to buy. Moving on to the fourth REIT of this list, we take a look at the industrial real estate juggernaut, Prologis Inc., which trades by the ticker PLD. Prologis is a mighty name in the REIT business, and one of the top names within industrial spaces. It has a market capitalization of over $100 billion, and has a strong presence established in North and South America, Europe, and Asia. The company's tenants include Amazon, FedEx, UPS, DHL, Samsung, PepsiCo, BMW, and many others. Despite dealing with such top players across various industries, its top 10 tenants make up only 14% of its total revenue, whereas its 25 biggest clients together contribute less than a fifth of overall revenue. Prologis therefore holds tremendous bargaining power, and cannot be easily subdued. The REIT is so spectacular in its game, because of a strategic focus on irreplaceable properties in markets that hold extremely high barriers to entry. Given the economic advantage it holds, Prologis typically develops facilities, rather than acquiring them. During the third quarter of 2022, Prologis reeled in revenue of over $1.1 billion, 10% higher than the prior year quarter, whereas funds from operations jumped 52% year-on-year, to $1.4 billion. Despite its tremendous size, Prologis has been on a high-speed growth path for the recent years. Its funds from operations have been climbing by a compound annual growth rate of 16.5% in the last 3 years, whereas total cash from operations has seen a growth rate of almost 19%. Given such tremendous growth, the management has been consistent with dividend payments, which have climbed by a compound annual rate of 14.2% since 2019. Prologis offers investors the best of both worlds, with stability through its large scale, as well as a reliable growth engine in the double digits by every metric. For these reasons, PLG is too compelling to overlook. The final REIT we present on this list is that of Alexandria Real Estate Equities, which goes by the ticker ARE. This urban office real estate player is headquartered in California, and specializes in the technical domains of agricultural tech, life sciences, and IT campuses. Each of these areas that the company has dabbled in are highly innovative, and possess rapid growth potential. This in large part explains the company's stellar top and bottom line growth as of late. In fact, net income to the company during the third quarter of 2022 soared by an incredible 215%. Similarly, its dividend growth rate of 5.75% is staggeringly higher than the sector average of 1%. In addition to its performance and growth, its balance sheet makes it especially attractive to investors, with liquidity of over $6.4 billion accessible to the company. This makes the company very capable of funding expansion efforts, without having to compromise on its dividend commitments. Similarly, the green flags continue to pop up, even upon analyzing the company's debt. The weighted average of the remaining debt term exceeds 13 years, with the average interest rate at 3.5%. Moreover, over 95% of this debt is a fixed interest arrangement, protecting the company from aggressive interest rate hikes by the U.S. Federal Reserve. All of these factors makes Alexandria's REIT, and the income derived from it highly safe, and perhaps a great pick as we enter into a possible recession. That's all from us in this video. We hope the insight we aimed to deliver has proven valuable to you, and would allow you to ensure your portfolio is well exposed to the resilient REIT opportunity. We would love to hear your feedback about our list in the comments below. To gain a deeper insight into different stocks that are fit for various investment strategies, be sure to check out our website, stockstelegraph.com.